A lot of the mainstream media is pushing agendas. People listen to headlines. They want to hear the glimpse. They don't want to dive deep into the data. With the housing market right now, I mean, just give me your overall opinion.
It's a very unhealthy housing market, and it's a very constrained housing market. But affordability has gotten so deteriorated between the prices overheating, the rates shock, and then income's not keeping up. Affordability is just maxed, right? And so there's a huge amount of pressure on politicians to act. And there's not a lot they can do, really. They can act like they're going to do a lot, but what they will do a lot of is scapegoating, right? And they're going to scapegoat everyone across the industry, of course. I think the Fed is kind of worried about how deteriorated housing affordability has gotten.
The Federal Reserve's job is price stability. I mean, we hear Jay Powell say that every time he looks at the teleprompter or some pre-written speech. Well, where was their focus on price stability back when rates should have been raised and they should have slowed it down in the first place? Was their head in the sand? Is their mandate for the people or for the banks? I would question that. Lance Lambert describes the housing market as unhealthy. That's an understatement. As home values went far beyond incomes, and that's a big problem. Now, one of two things must happen. Home prices must drop significantly, potentially causing literally millions of homeowners who purchased a home within the last 4 years to be underwater. Or incomes must rise substantially. Now listen as Lance and I discuss the real problems existing in the housing market today and decide for yourself what you think is about to happen before buying or selling a home. Lance, thanks so much for joining me today.
Yeah, thank you so much for having me. Always a lot going on in the housing market. The past few years in particular, it's been really crazy. So looking forward to chatting about housing again.
Yeah, man. Well, the last video we did together, audience loved you. A lot of views on the video, a lot of comments, and really excited about your new business, really. I mean, ResiClub, you've been at it for a little bit here, but just kind of start us off, Lance, for those that don't know you. Just give us a little brief foundation on your background in housing, reporting on the housing market, and also tell us about this new venture, ResiClub.
Yeah, so I'm a longtime financial journalist, been in the game around 10 years, worked at places like Bloomberg, and was the longtime real estate editor at Fortune magazine. And I had also had a point in my career where I wanted to pivot out of media, become a data scientist. And I was working at Realtor.com for a couple years there. And that's when I got really deep into the listing data, housing data, real estate. And then when I went to Fortune, and then the pandemic housing boom started, it kind of all clicked and I needed to start reporting quickly so people got, just some better insights, because a lot of the media stories are like top line. They kind of make everything seem like one size fit all. And you know this, you've been in the real estate game. Things vary so much across the country. And even within, markets, the product type and all that can vary a lot. So I got deep into the reporting, kind of built a bit of a following on Twitter during the pandemic housing boom and the rate shock. And then, decided last fall, you know what? I kind of want to do my own thing. Don't want to be a part of, these bigger legacy media companies anymore. I want to go out on my own and just, really make my reporting strong and really just focus on one topic, which is the U.S. housing market. And so I created ResiClub. It's kind of a hybrid between a news organization and a research company. We do a little bit of both, where we're doing reporting, and then we're also doing research projects. We run surveys of single-family landlords, investors, homebuyers, sellers, real estate agents, just trying to figure out what's going on in the housing market. And then really, similar to what you do kind of, which is try to be an independent voice, right? Be a little different than maybe, Zillow and NAR. And, we don't have one stakeholder in housing. Buyers listen to us, sellers, investors, home builders, agents. But we want to have a broad audience and don't speak to just one group and just try to figure out what's going on in the housing market. So that's my goal each and every day, is just find out what's going on in the housing market and try to tell my audience.
Well, I think it's great. I think that we need you to be doing that because I think a lot of the mainstream media is pushing agendas, and it makes sense because people listen to headlines. They want to hear the glimpse. They don't want to dive deep into the
Yep.
data, and we really need people like you doing this because the data is so manipulated, and unless you're really almost like an investigative journalist type of approach to this because, looking at, and I love your postings and I think you really get a lot of the conversation started and you're really wanting to provide accurate data. So I really love that. I'm excited for our talk today. I do want to ask some of your personal opinions on some things as we go along because I know when I talk to people that are running businesses and doing things in certain markets, they also have in the back of their mind their own opinions, and a lot of that drives their desire for accuracy and challenging what everybody else is saying. So I hope you're okay with that today.
Yeah,
But
go for it.
yeah. So, but I want to start out with saying, what's your overall opinion? And you could take that, Lance, wherever you want with the housing market right now. I mean, just give me your overall opinion.
Yeah, I would classify this housing market as two things. It's a very unhealthy housing market and it's a very constrained housing market. And what occurred is during the early months of the pandemic, housing demand accelerated. And so the Federal Reserve did a paper in mid 2022 that found that to match the increase in housing demand, which was driven stimulus, low rates, work from home, all of that jazz, to match that increase in housing demand, housing starts and home construction would have needed to increase 300%. Supply is not elastic like that, right? You can't just housing starts just can't triple overnight. There's a supply chain and all of that. So that was never going to be possible. And so what occurred is when you can't match the increase in demand with the supply, you overheat and prices overheated to a historic degree, really. We've never had we've had periods of overheating prices, but we've never had 18 months of 43% jump in US home prices. So that was really historic. And that overheating in prices was followed by a rate shock, right? So mortgage rates went up from, 2, 3%, and they were kind of like in that 3 to 4 before the pandemic. And then they went 5, 6, 7. And then some people, depending on your credit, even up to 8. And that, the move up in prices, the move up in rates, income didn't keep up with it. So affordability is historically strained right now. And what that's doing to the market, that unhealthy side, and the fact that we got so far ahead, it's constraining the market, right? So there's not much churn in the existing market. A lot of people who would like to sell their home and go buy something else, they're not doing it because they don't want to give up that 2, 3, 4% mortgage rate and go get something 6, 7%. And even if they would like to do it, a lot of them aren't even eligible for that new mortgage given their income. And so it's constraining turnover in the housing market. And recently, we've started to see the amount of listings that have come into the market, which is still very low in terms of new listings. They're not all getting absorbed, right? They're not all getting bought because the buyers, they're also constrained. And so we're starting to see inventory start to build in some of these markets. And so as that continues to build and some of these markets that have put downward pressure on prices, like we're already seeing in some of the coastal markets like Austin, New Orleans, around down into Southwest Florida, even into parts of Tampa now, Cape Coral, Sarasota, those parts of the country. And some of the other parts, it's kind of taking it to more of a balanced market. And then there are still some of these places where, because of the overheating during the pandemic housing boom, and they haven't really come fully out of that, they're still really tight on the technicals, right? And that's the low active listings. And that's places like in the Northeast and Midwest, where despite all of the super unhealthy move up in affordability, those markets have still stayed tight. And that's why some of these parts of the country have had some resiliency. So, big picture, to answer your question, I'd say unhealthy and constrained, but it all does vary so much across the country. But it's not, a normal healthy market right now.
Let's talk about before the Fed started hiking rates in 22. What did you think of the market at that point? I mean, obviously, you just described it, 43% price jump in about 18 months, depending on where you were in the country. I mean, I think that's a good average, but I think some markets even saw larger spikes
Yeah.
than that. What do you think of the market that was prior to the rate hikes?
Yeah, where we were at that point would kind of be on the unhealthy side. We'd seen a lot of overheating in prices. It took a lot of these markets from a historical perspective really far beyond incomes, right? And so some of the markets did immediately see give up. The places like Austin, Texas, where home prices were up 68% in like 20 months. And as that California demand that was coming in slowed down, and they were just so far beyond local fundamentals that market just immediately started to see some give up. So at that point, I would kind of classify a lot of the market as unhealthy, right? And then what immediately followed is kind of what I consider the constrained, which is super unhealthy affordability. And that really constrains the housing market. And so the existing side of the market in particular, uh, it crashed. Existing home sales fell at, you know, at essentially the fastest rate they'd ever fallen or tied for the fastest rate. And that's in the second half of 2022 as the market's really, getting constrained by those the tough, unhealthy affordability, which really became a reality once the rates started to move up.
Yeah, I completely agree with what you're saying. I mean, from on the sales side of things, I mean, what we were witnessing happening was so unsettling. And people are quick to say, "Yeah, but you profited from it, or you made more money than you have in any other time in real estate sales," and that's true. I mean, there's no doubt. I mean, there's a saying that blind squirrels can find nuts, and I mean, that's what was happening. People were getting the real estate license. We had the biggest influx of realtors entering the market. We had hit 1.6 million, I think, in licensees, a historical high, and at one point that was higher than the amount of homes available for sale nationwide. But it was very unhealthy because we were watching people overpaying crazy prices above the appraised value, and home prices don't really adjust that way. It's not really how the housing market operates. But we were finding those new comparable prices once they were closed that gave the appraisers really the authority to, I don't know. I think it's horrible what happened. And, you look at the appraisers work for the banks. And a lot of homeowners think that they're hiring or the appraiser, and they're not. They're basically paying the appraisal fee, but the appraiser works for the banks. And the whole system was just ridiculously overheated. Now, let's talk about the sales now, because we know that sales volumes are down. I mean, some say 40, 50 year lows in sales. Now, real estate agents, the same ones that were fueling the market or helping to fuel the market, say that it's just seasonal sales happening right now, that, people are summer vacations and back to school and things like that. What do you say about the sales volume nationwide? Do you think it's seasonal, or do you think is due to the struggling consumers?
It right now, what we're seeing in the existing market, this is 100% affordability. The unhealthy affordability is what's gotten us here. And so right now, the amount of existing home sales that's happening in the housing market is at levels all the way back to 95. And actually, the levels right now are actually comparable to the peak from 78, 79. So you're way back. And this is a country where, we have over 100 million more people than then, right? It's a much bigger country. And so what's occurred in the existing market is that a lot of the churn in the market or move up, or, they kind of want to go move somewhere, to be closer to family, but they have that low rate and they're not doing it. So a lot of the churn and turnover in the market is just knocked out. And what's left are like deaths, divorces, pretty much the things that have to occur, right? This is kind of, the floor in terms of existing home sales. We have fallen all the way to the floor, and it's just like the deaths, the divorces, and we're just kind of moving along. And until we get some type of affordability improvement, it's going to be tough to get that existing home sales up. So if rates were to come in a bit, that can maybe help a little bit. Some of these markets right now that are seeing some price declines, that can help a little bit to get those markets back closer to, where buyers might transact. But the real big wild card here too is also the economy, right? Where does this labor market go? Is this Fed actually going to achieve, this unicorn of a soft landing, or is it all false hope, right? And so where the labor market goes and where rates go, and how much price give up some of these markets have, that's all going to help to determine where the volumes in the existing market get to. But if you go back and you look at the late 70s when we peaked for existing home sales, it took a decade to get back up. So a lot of these real estate agents who think, oh, we're down for existing home sales and it's been 1-2 years, rates are gonna come in and we're gonna soar right back to where we were in 2021. I think that's really naive, because even if rates come down a bit, even if prices fall a bit here, it's still actually fairly tough on the affordability side. So I think existing home sales are probably going to be constrained for, quite a period of time. That doesn't mean we're going to stay at this very low level that we're at right now, because we're at essentially a multi-decades low. But I wouldn't think we're getting back to, 5.3 million existing home sales in 2019, normal pre-pandemic levels, or let alone the 6.1 during 2021.
From your experience with journalism and, now, I mean, you're utilizing basically all of your experience as far as being a data analyst, but really on the reporting side, 10 years experience doing this, essentially. What is your opinion of the Federal Reserve? I mean, do you think that they should be manipulating markets the way they do?
Well, you you just asked the toughest question that's out there for any financial journalist, because the Federal Reserve, which was founded in 1913, it slowly over time morphed, right? It didn't get its dual mandate until 1970, and then it started to also focus on employment and not just inflation. And really, over time in the 2010s, the federal government leaned on the Fed to induce the recovery, right? And then during the pandemic, it was really, the federal government leaned on the Fed to kind of steer the ship through that. And then they kind of overcorrected. They probably did too much, and they won't probably admit they did too much, but they did too much. We got the inflationary shock, and they really had to jump into action there. So it is tough for me to come out with a hard stance on the Fed, because everything that I cover trickles down and is impacted by monetary policy, because I cover housing and the economy. So those two are super affected by the Fed. And so I got to kind of be careful there, because if I come in with too hard of an opinion, that can affect my ability to be really objective in the future as I cover things. But at the same time, if I'm not alert of these things, I could also come off as very naive as well. So I'm kind of trying to thread the needle, and that is a very tough question. So I hope that wasn't a full-on deflection, but I see what you're getting at.
I hope you're enjoying the show. I'd like to just take a moment and ask you to follow Sachs Realty on your favorite social media and audio platforms. Also, this episode is brought to you by our own SachsRealty.com. If you're looking to buy, sell, or rent a home or commercial space, we're your resource to do so. On SachsRealty.com, you'll find amazing agents, lenders, and title companies nationwide that we trust to help you achieve your real estate goals. Don't see service providers in your city? No problem. Reach out to me directly and I'll set time aside to personally discuss your goals, and then I'll connect you directly with someone to assist you. Now back to the show. In my opinion, when we look at, there's a disconnect. I mean, you certainly, you're smart. You've been covering this for quite some time. You see what's happening. You see where the narratives are. You have to. You also have to see that there is a narrative. And I'm not trying to be conspiratorial here. I'm just trying to say, look, we have people that are in charge that are running the ship here. I could see where they should have raised interest rates. Well, for number one, I could see that interest rates should have never been as low as they were. You don't give away free money. There's a cost of doing business. Price stability is fair market value, not manipulation of the market, not directly, doing what no one else will do. And that's what the Fed has done. They've said, we're going to lend money at zero. Who would do that? There is no investor in the planet that is going to give you money to run a business or anything else for that matter, buy a house or whatever you're going to do with borrowed funds and expect to not get money on return.
Yeah.
They artificially, right? They should have never dropped them to the rate that they were.
So here's kind of how I cover things is I'm less of covering things of like, here's how things should be, or here's what was kind of done wrong. And my coverage is kind of more like, here's what it is, right? Here's what's happening. Here's where we are. And, and I don't go at them as much. But there's definitely, when I was watching it, and, seeing home prices overheat, and we still stayed at ultra low rates for more than a year into it, it's interesting to say the least. The fact that prices were already overheating at the end of 2020, and the Fed didn't hike rates until March 2022. And at that point, it wasn't fully reported out because Case-Shiller lags, but home prices were already up 45%, 43% in 18 months. So it was definitely interesting to see that play out. I think the honest truth that not too many people want to just admit, frankly, is that policymakers, not just in the US, but across Europe, Australia, a lot of these developed countries, they essentially decided during the COVID-19 lockdown, recession, and following that it would be a no pain recession, right? It was, they reacted to COVID-19 and they had the strict lockdowns. And so they created a tremendous amount of economic support because they kind of saw the thing as, it came out of nowhere, right? And a lot of businesses, especially in like tourism and stuff, they were acutely hit by it, more so than others. And they just decided they were going to err on the side of probably doing too much and pushing employment all the way back to where it was at pre-pandemic levels. They tried to do it very, very quickly, and then we overheated in the economy. And so there's definitely a truth to the fact of the supply chain side, where during the COVID-19 lockdowns, that created a negative shock to supply, but there was also a demand shock that was positive. And so while supply had a negative shock, demand was getting a positive shock from ultra low rates and all the stimulus, right? And so they were going in two different directions. And that's where you got the inflationary shock, which then was followed because they had to go into action by the rate shock. So it's interesting to kind of seeing how everything played out. Hindsight's 2020. If you want to go back and try to figure out what exactly was the best way to do it, I would think that, you'd probably have rates a little higher sooner, right? Maybe 6 months sooner. And then affordability doesn't get as strained in the housing market. And we're probably in a bit less of an unhealthy place for housing, in a bit less of a constrained environment. But again, I'm not a policymaker. I want to be careful of getting, having too big of opinions on stuff like this. Because again, I want to be able to cover it. And I kind of want to focus my coverage less on like, here's what we should do, here's what should have been done, here's what we should do going forward, and more of just like, here's what it is, here's where we are, here's how things are, not trying to, put lipstick on it. It's just like, here's what it is. And that's kind of what I want my coverage to be.
Yeah, and I certainly appreciate that, and from a reporting standpoint, but the Federal Reserve's job is price stability. I mean, we hear Jay Powell say that every time he looks at the teleprompter or some pre-written speech when he stands up there after they have their meeting. He says that their focus is price stability. Well, where was their focus on price stability back when rates should have been raised and they should have slowed it down in the first place? Was their head in the sand? Did they not know that prices weren't stable? I mean, it doesn't make any sense. You can't inflate asset classes and expect that they're not going to have massive implications. You say hindsight's 2020. I don't think they look in the rear view mirror. I mean, there's a lot of good sense about, hey, want to know what's happening in the future. Let's take a look back in history, a couple steps back, and see what happened before. I think what it is myself, the Federal Reserve are bankers. They work for the banks. I mean, is there mandate, for the people or for the banks? I would question that. But the only reason I bring that up, Lance, and I appreciate your position, man. I want to look at something here because this is from Wells Fargo. And I'm not saying that I like Wells Fargo because, I mean, being in the real estate business, I can tell you one of the, when people said they had Wells Fargo, we were like, oh man, is it ever going to close? They went through a hard period of time where they had a real difficult time closing loans, it seemed. But anyway, let's look at this. I want to look at this chart because two charts I want to focus in here, and I want to get your opinion on. Number one, it's and this was just published August 19th, so this is hot off the press. This is the most disturbing thing to me because when we look at least from what I just said about the Federal Reserve, and you saying that at least they probably should have implemented the higher rates sooner. Look at this chart. Federal funds versus mortgage rate. This is the forecast, man. This scares me. I was hoping that we would never be thinking about rates below 4% again or 3.5% again. But this is a collection of what it says here, source Federal Reserve Board, Freddie Mac, and Wells Fargo Economics. It's showing that conventional fixed rate mortgages by 2025 are going to be less than 6%. Do you think there's a possibility that they will do quantitative easing again and drop these rates into the 4s or lower?
My honest opinion is based on where we are right now, unless the labor market deteriorates faster than expected, I think that's unlikely. I think there's probably, and even if we were to have a downturn, I don't think they're going to necessarily go back to buying QE for mortgage-backed securities. I think the Fed is kind of worried about how deteriorated housing affordability has gotten. And I don't think they would want to go down that route again with MBS, even if we were in a recession. Now, if you're talking about like a huge financial crisis and unemployment's really high, I think the Fed has kind of told us through their history that they value employment getting back. That's a part of their mandate. Housing's not. And so if we're talking about a really big recession, deep financial crisis, then maybe. But with that outlook there, that's more of, Wells Fargo believing that we're going to have some type of like soft landing where unemployment ticks up closer to like 4.6%. And we get a little bit of a compression in the spread between the 10-year and the 30-year fixed mortgage rate. And we get down to like 5.9 average 30-year fixed mortgage rate by Q4 2025, which that's a pretty, that's probably where consensus is in terms of these forecasts right now. Fannie Mae thinks 5.9 by end of Q4 2025. Moody's is the lowest. They think 5.5% by the end of 2025. And then the Mortgage Bankers Association thinks 5.8% by Q4 2025. So they're all 5.9 to 5.8. But none of them think that unemployment is going to go really high from here. They think it'll tick up a little bit, but stay under 5. They essentially think that the economy is going to soft land, even if things are kind of choppy, and some subsectors have, recessions themselves over the next year. That's kind of the consensus forecast, and a little bit of a rollover with the federal funds, with the first rate cut starting in September. But for rates to go much lower than that, you would probably have to have a scenario where there is a downturn, right? Where the Fed has kind of kept rates higher than maybe they should have in terms of restrictive over the past year. And we have some type of, like Fed induced recession. And then in that scenario, if the labor market were to break like that, you'd probably have, mortgage rates coming down faster than expected. There's
So
also the
let's
other scenario, though, where inflation is a bit stickier than people think, right? And that maybe labor doesn't deteriorate as much, and then we have a bit of a higher for longer. So the Fed is kind of cautiously going into this rate hike or the rate cutting cycle, but it doesn't necessarily mean that mortgage rates are going to poof and go down really hard, really fast. We'll kind of have to see how labor and inflation play out. But right now, the unemployment rate has ticked up from its lows of 3.4 to 4.3. And that kind of has the Fed's attention. And they're starting to focus a bit more on the employment side of the mandate and less on the inflation side. Although I should point out, inflation's at 2.9%, still a little above target. And it's going to take time to get closer to that 2%.
Yeah, and this is disinflation, not deflation. So that's still, when we're looking at these, inflation numbers, I mean, they're over last year, they're year over year. And when we were looking at, those high costs, they're really not coming down. Let's pull that chart back up again because I want to just stay on this a little bit longer. So let's just say that that this is right, that this is what they're really planning on sticking to, and I hope so. I hope that the Fed doesn't go down to 1% or zero like we saw from '09. I mean, looking at this all the way to 2015 into 16, to where they started raising rates at all, and then right as soon as we hit 2020, they dropped them right back down again. But let's just say that they do keep these to 25-year highs, 30-year highs, 50-year highs, whatever. Chart doesn't go back that far. And this is going into 2026. So the difference now between where mortgage rates are now and where they're predicted to be in 2 years is not a huge difference in what will equate to savings in payments, especially when you now consider the cost of insurance, taxes, home repair costs, and things like that. So with that being in mind, let's just say you think this is a good assessment. I hope that this is where it is. It scares me to think that they would drop down into the 3s and the 4s, even below 5 in mortgage rates, or that the industry would go in that direction. What will continue to happen to home prices? Because there are some people that that say what I'm saying is completely wrong. I'm looking at the economics, the affordability index, and the home prices with all the cost of ownership. I'm saying prices need to come down. If they keep this for 2 more years, what's going to happen to home prices from here?
Yeah, so I think it's worth pointing out that over the past year, the average 30-year fixed mortgage rate has come down from 8.03 with the Mortgage News Daily down to, I think it's about 6.45 right now. So it's come down, 1.5 percentage point, pretty big drop. And during that same time, home price growth has actually decelerated, right? It hasn't accelerated. That drop in rates did not push up home prices more. And we're starting to see with the, U.S. home prices as measured by the Zillow Home Value Index, which is a little bit in front of the Case-Shiller, it's decelerated now to 2.8%. So it's went back below inflation, and it's going to continue to decelerate, Zillow says, to the end of the year down to 1.8. And then by this time next year, they think 0.9. Who knows? That's just their model. But the reason I bring that up is that we've had a bit of a drop in rates and it hasn't accelerated home prices. So I just want to point that out, saying that, just because rates come down does not necessarily mean that home prices have to accelerate, because the last year just proved that they didn't. But I think what's probably going to be true is that regardless of the rates, that what's really going to drive home prices for the next 5 years are the local fundamentals, right? And that varies across the country. And there are some pockets of the country that are going to be stressed and they could see falling home prices. And in fact, they have. New Orleans, parts of Louisiana, pockets of Mississippi, areas in Texas, parts of Florida, these areas where not only did they see home prices go up a lot, not only did they see the rate shock, but some of them are getting hit by echo shocks through property taxes in Texas. And then in Florida, these home insurance premiums. And so affordability there has just gotten strained more. And they've also seen a rollover in migration where during the pandemic, there was a lot of people coming down to those markets and moving in. And there's still people moving in. There are always going to be, positive migration to those markets for the foreseeable future, but it's not as intense as it was before, right? And maybe the people who are coming aren't as deep pocketed as some of the wealthy people who moved during the pandemic. And so I think what's going to drive prices are really these local fundamentals. And what we've seen over the past 2 years, and if you want me, I could pull up some of my charts and show inventory and prices that I
Sure.
track. But I think it's going to vary. Everything's going to vary, is kind of my take right now. A lot of bifurcation in the market. And if you go back to the 80s, if you look at the national prices for the 80s, prices kept going up. But if you looked at the market level, at any given time, around 25% of the markets through the 80s were falling for home prices. And so just because you have a top line aggregate for these indices that is going up doesn't mean there's not pockets where it's going down.
What do you think the effect will be on, one of the things that I've said is, and people want to argue about it, because a house is a depreciating asset. And, they want to say homes appreciate. And in fact, they fall apart when people don't keep their houses up. They go through functional obsolescence, design obsolescence. People look at houses with 35, 40-year-old kitchens. A lot of people don't find that attractive. They want to have a newer kitchen or new windows or a new roof. They don't want it to be raining inside the house, which makes perfectly good sense. In fact, you can't get a loan in a lot of cases if it is raining inside the house. What do you think the long-term effect on rising material costs that are well beyond? When we look at material costs, especially things that are petroleum-based, right? We get into commodities markets, driving the costs of products. With the high cost of materials, the high cost of trucking and shipping, the high cost of labor, the fact that most of the labor is unskilled. We have people doing construction projects and building houses that don't know what they're doing. And the craftsmanship shows. I'm a builder. I can say this. What do you think the long-term effect on the home repair and replacement costs will do for resale values or prices of homes? If you walk into a house and it's gone through some obsolescence, what's going to happen to the sale price of that home?
Well, it's a tough question, but a part of what goes into that question, which the replacement costs, people are feeling that right now, and it's a pretty big shock. And how they're feeling it is not necessarily that they're having to replace things in their home. They're feeling it through insurance, because one of the big drivers in insurance right now, and yeah, I know in a lot of the media outlets, they'll say it's, climate risk and all of that stuff. And that's, probably a part in some of these markets. But the big driver for insurance right now is that construction costs have went up so much and the replacement cost has soared. And so that replacement cost in the real world is up 50% since pre-pandemic levels, 45, 50%, depending on what we're talking about. And so that shock is getting fed into the insurance market right now. And it's getting fed in the residential side, and it's also getting fed into the commercial side. And now in terms of all the repairs and stuff like that, individually, people can manage those and kind of be savvy with them, but you can't totally hide from an increase in replacement costs, because where it bites you is on insurance. And I think a lot of people kind of forget about that's how that system works.
Well, when people go in to look at a house, do you think they're going to put the same value that you think your house is worth because you have things that need to be replaced? I mean, they're going to be asking, we see it now, they're asking for these things to be fixed I think June was the highest in contracts falling through nationwide than we've ever seen in the history of tracking, real estate sales. I mean, buyers are putting their foot down. They're having home inspections again. They're looking at a house that has been, what they consider overpriced and needing a lot of expensive work. Don't you think that's going to drive prices down?
Well, so I think a part of that, it is kind of like I would almost call it a hidden price decline, right? Because what's going on in the housing market is that 2 years ago, you could sell almost anything for top dollar, right? You just throw it out there. It was, you could waive all the contingencies and stuff like that, and you were getting a lot of buyer interest. And then today, to sell that same home at the same dollar amount, you might have to spend $40,000 on repairs, right? And so that 40, if it sells for 440, that home, and it would have sold for 440 2 years ago, in the price indices, the medians and the Case-Shiller and the repeat sales indice, it wouldn't get registered as a decline. But that person might have had to spend $40,000, $50,000 to move that same product, given there's so much less buyer interest, depending on the market. So that kind of gets rolled into some of the hidden price declines in a way.
Which brings me to the point of, and I completely agree, and that in itself is a market crash. I mean, it's, when you're looking at it and you say, well, sellers could have sold something and not, paid 10% or 20% in repairs, or the cost of their contracts falling apart. But do you think there should be a better way of what do you think the agenda is here? And here I am back to my agendas. When you look at, you're saying, you're talking about Case-Shiller, and we got a chart here I'll pull up here, and you had mentioned if maybe pulling up a chart or two if you wanted to do that. But let's look at this Fred chart here. This is showing S&P CoreLogic Case-Shiller U.S. National Home Price Index. And, for one, I wanted to pull this up for a multitude of reasons. One being to show how ridiculous the trend line is in the home price index across the country. Ridiculously, this goes back to, the early 80s, 1987, showing that from 1987 really to into the early 2000s, the index sort of, was on an incline, but on a very, very gradual incline. Once we hit after we had the recession, right before you see the 2002 line start to go up, by manipulating rates again. I mean, this is when we saw over decades the highest home price increases that we really have ever seen post-World War II in shortest period of time. And then we obviously saw what happened when we hit the '08 crisis, the GFC. This chart has actually been even changed and manipulated to make it look like it doesn't even look that bad. But just a year ago, if you looked at these charts, there were more straight ups and straight down lines, but I get it. We're constantly massaging data. And then we can look at the rocky road from 2010 really till we hit the 2020 era here, where we watched the largest real estate bubble take flight. And really, until we got to 22, where Lance, you're talking about that those massive, fastest rate hikes we've ever done in history, and then we've seen some adjustments, and now they're back up again. So, I guess the question that I want to go over here, because this is going to be really good for your resi, hopefully, because this is what I think we really need to do in the developing side, and how important this information would be. Not popular, but important for the consumers to know, because so much of this data is manipulated. When you're looking at median or you're looking at average, it means basically nothing at all. I mean, you may say it means something, but I don't think so. And the reason being, because what happens is when we get a median price, that's the middle price of what is being sold. And if the economic fundamentals change and people start buying more expensive houses, or only they're the ones that are buying houses and they're more expensive, then fundamentally that median price is changed based on the new sales data. And if we take average, it's kind of the same thing, because we grab all the sales done in a period of time and we divide that number, that volume number, or that sales number divided by the volume, and it gives you an average price. But what can we do? Because I see home prices falling 30, 35% in our market. We see it. Every house that's on the market today, 30, 35% of them, some in other markets are even higher than that, have experienced it. At least these active listings have experienced at least one home price decline. What kind of a system can you build with Resi? And this is kind of a challenge that would give a more up-to-date market analysis. Number one, not lagging, but current. How could that be done? And number two, isn't it kind of important that we do a better job at sales comparison than just median home prices and average home prices?
Yeah. So you bring up a lot of great points, which is the median has always been affected by mix shift, right? If the population of the sales changes. So during the housing crash, if you look at new home prices, they didn't fall as much as you would think. They only fell like 12, 15% in some of these aggregates for new home prices. And the reason is that the bottom of the market, and you know this because you went through it, you lived it, literally imploded, right? And then we changed the entire, standards for the mortgage market, and that even hit the bottom half even more. So what builders had to pivot to then, they kind of stopped selling the entry level stuff. They stopped that side. They focused on the little bit of the market that was left, which was that higher end, right? And so, and those prices came down too, but because the proportion of the sales skewed to more bigger homes, and you can look at this in the crash and following the crash, the typical square foot size of new homes went up. It kept rising. And so that kind of helped to keep new home prices at the median from falling as much as they did in the real world. So that's an example of mix shift at play. And that even happens today for builders in terms of if they're selling more in an expensive area or selling more in a low cost area, that can affect the medians, right? So the medians are always going to get skewed by mix shift. The goal with the creation of these repeat sales indices, which is like a Case-Shiller, is to take a home and then when it sells, like let's say 12 years later, they have a calculation, and it's like it's 40 pages long. You could Google Case-Shiller methodology, and that's kind of the methodologies for these repeat sales indices. But they take homes that sell, and then when they have and they compare it to a past sale. And so they're just taking a slice of the market, right, with the repeat sales. The problem that you can have there is if some of these repeat sales indices don't cover all of the market, right? So in particular, FHFA, they don't cover as much of the higher end side of the market. So in the second half of 2022, when home prices were falling in a lot of markets, and especially out west, the biggest hit to home prices was at the top of the market. The most expensive homes came down the most. Well, FHFA doesn't have as many of them in their data universe, right? And Freddie Mac doesn't either. So they didn't show as many declines as some of the indices like the one you pulled up, Case-Shiller, which covers all single family homes. So I think the point I'm getting to there is there's not exactly a universal standard, or there's not, you can't, what all these indices are is they're a proxy. They're just a proxy. And you have to kind of know how to read all of them, and they're all different, but they can give you itty bits of insights. Now, what I think is actually the most powerful metric is really just active listings. If you're in a market where your active listings are shooting up really fast, that's a telltale sign, because the only way that's going to happen is if there's a lot of weakness in the market and sellers can't sell for the dollar that they're expecting. And so that inventory begins to mount. And so if you see that, even if the medians for your market aren't necessarily moving, there's probably a lot more weakness under the surface than you're seeing in those medians. And it's probably a market where you could go out and maybe find a deal, right? And kind of get relative to what you could before when actives were tight. Are you fine if I pull up and show my inventory tracker?
No, go ahead. I love it. And while you're doing that, I mean, I think it is important. The problem is, to look at the existing inventory. The problem is that this is not what the media is covering. And so what they're doing is they're basically giving data. They're not talking about the important information that makes consumers, helps consumers to make informed decisions. The problem is that the agents, they're also commission based, and they want to make sales. They want, if the media is pushing that the housing market's resilient, unaffordable, but home prices aren't coming down, when in fact they are, they're doing a massive disservice to consumers. That's my problem.
A part of what's happening is that some of the aggregates aren't dropping as much because there are some of these tight markets across the country, in particular, some of the Midwest and pockets of the Northeast. I mean, here, I know a relative who bought a house for $179 at the end of 2022, and he just sold it this spring for $290. Like parts of like the Midwest in particular,
right? But I agree.
Supply. So we're kind of, but yes, I hear what you're saying.
I agree what you're saying, but if we're talking about new inventory, that price today is probably being challenged. And so, if we were being transparent with what's happening, and the problem is, and I want to know how you think about agents as well, because the problem is if an agent is pushing a buyer to pay that price, instead of diving in and saying how many people are willing to pay that price, how many offers do they have on the table right now? What does that look like? The agent for the seller obviously is trying to push the highest price. It's what we do. You have to be honest though, but the agent for the buyer is trying to get, or everybody's trying to get a commission check. My point is, when we're looking at inventory, we're in a very tight market here in Maryland, Lance. We're in one of the highest income earning areas in the country. And, we're just government employees everywhere, and government contractors, and job stability. You're working for the government, you have job stability. We're still seeing those markets right now where buyers are like,
Yeah.
No.
Is it happening at all price tiers or mostly the top half?
It's happening in them all.
Really?
It's happening in every price tier. It is, I mean, we just did I just pulled up in a live stream and went over multiple counties, showed it right on. I did 250,000 to $1 million.
Mm.
And that's the meat and potatoes. I mean, if you're looking at 250, if you're here and you're buying a house for 190,000, it's probably pretty distressed, or probably a lot of in an area that's just not as desirable, or it has some obsolescence. I'm not really tracking that as much because the real super cheap inventory, is investors, a lot of it anyway, right? But I'm talking about $250,000, $1 million here in Maryland, and we're seeing where 35% of the active inventories had at least one price decline. That's pretty major. And with days on the market skyrocketing, that's in Maryland. I have friends all over the country that can pull data.
Yeah, let's go through and look at the inventory rising across the country. So I do this one monthly. This goes out to my premium members. It's looking at 800 metros, 3,000 counties. And what you see in the US is that while we're still below pre-pandemic levels for actives, we're up 37% year over year. And they're rising in almost every market in the country, with the exception of some, around like Las Vegas. And in Florida, you're up quite a bit. I mean, my scale only goes to plus 50 because I didn't want to I wanted to kind of show where places are up. But if I did it to 100, you would still see a lot of dark green in Florida. So Florida, it's really everywhere right now. Actives are rising. And then this is metros sized by the amount of active listings. Again, you see it rising pretty much everywhere except Las Vegas. And even in some of these tight markets in the Midwest and Northeast, they're starting to rise now for the amount of active listings. And usually these interactives I have, I make them interactive where you click off on them and you can kind of go through. And in there you see Miami, has 38,000 active listings. Last year at the same time, they had 22,000. And so they're barreling towards pre-pandemic levels at a really fast pace. I mean, Miami's up 72% year over year for active listings.
Right. So the absorption rate, now you're talking about, inventory going up. Do you see the absorption rate increasing as well? Or do you see the absorption rate declining?
It's going up because the homes aren't getting absorbed. They aren't getting sold at the same rate.
But there are plenty of buyers out there, so that doesn't necessarily mean that it would be that way, right? So you could see inventories coming on the market, but there could be more sales and contracts happening too.
That hypothetical you're giving is what happened in 2021, where new listings actually went up a bit, but there were so many buyers, everything got absorbed, active listings were super low. So this is actives, and the number of new listings coming on the market is still very low, but the few homes that are coming on, they're not getting absorbed at the same rate. They're not getting bought. And so inventory is beginning to mount and stack in a lot of these markets.
Yeah. Well, I think, and this is just the beginning. I mean, we talked about the economy and what's happening, with affordability at being low, and even with interest rates, like you said, I think the low rates now are baked into the Fed. Everybody expecting the Fed to cut.
Well, this one now is looking at now versus pre-pandemic. You can see that there's still a good chunk of the country that is still well below pre-pandemic levels, but we're getting back. A lot of markets are starting to get back, especially in the Southwest and Southeast. Florida's really came back really fast over the past year. And here you see it around the Gulf getting back fairly quickly. Places like Nashville, a lot of the Idaho and into upstate Washington has gotten back, Arizona, Texas. And then it's really this Northeast Midwest, and in particular, the entry level there that has kind of kept us from getting all the way back. But here you see it, a 4-year, 3-year, 2-year, like we're getting back fairly quickly back to pre-pandemic levels. And so of the 50 largest markets, Nashville, Jacksonville, Denver, Orlando, New Orleans, Tampa, Memphis, San Antonio, Austin are back to pre-pandemic, and Phoenix, Seattle, Dallas, San Francisco are already super close. And we're going to continue to see more getting back.
So this is the end of July.
Yeah, this is through the last week of July. Yep.
And I just want to say while you're on this, and this is great, Lance, this is really good, helpful information. The getting back to whether this is seasonal or not, now is not really the time of year that sellers would typically want to sell. I mean, obviously, if we're getting back to typical seasonality, a normalized real estate market, housing market, the best time to sell is prior to June 15th. I mean, it's once you get into, graduations, summer vacations, back to school, holiday season, winter, and a lot of the parts of the country, just cold weather in general. We don't usually see the influx in inventory until we're cruising into springtime. So when we're looking at this massive influx of inventory, this is happening. This may be telling a different story. This could be telling people that need to sell versus, just the one,
what's going on here is that the rise in the active listings, what's actively on the market, really a lot of this is people who tried to sell in the spring and they didn't get what they wanted. They couldn't sell for what they wanted. They didn't have the buyers there, and they've kind of strung out their selling to later in the year. I mean, we're into August, and a lot of these in some of these markets, homes that tried to sell in March, April, May didn't get the offers, and now they're having to do some of the markdowns. But you're absolutely right that this is it's interesting to kind of see it happening at this time of year. And I would guess that in the next few weeks, next few months, active listings would finally peak out for the year and start to roll over a bit. And then
we hope.
Yeah.
we hope for the sake of the sellers, right?
Well,
the buyers would like to see the inventory continue to roll.
Yeah, exactly. Yeah. If you're the buyers, you're hoping that what I just said is wrong and that active listings continue to build up more. That's just going to make 2025 more attractive for you, the buyer in your market.
Great information. What have you been following this NAR lawsuit settlement stuff?
Yes, I've been following it a bit. I try to keep more of my focus on the U.S. housing market and less of the industry stuff. But I think it's important to follow for a few different reasons. It'd be interesting to see how builders react. A Fortune 1000 builder told me a few weeks ago that around 70% of their sales have a commission, and that he would think in the next 5 years that'd be 20% or 20%.
Interesting.
Now, not many builders will say stuff like that on the record because some of them are trying to, not upset too many of the real estate agents.
Now they're begging them.
Some of them have come out with even bigger deals for real estate agents to kind of, catch their attention right now, especially because some of them have inventory that they're having a harder time selling and moving. So this is probably not the window where they're going to try to, get out of paying for buyer's agents. But it'd be interesting to kind of see how it plays out. And it seems like this is going to be something that's a multi-year thing. And, the opinion of like policymakers in Washington is that, people in the US spend a lot more on commissions than they do overseas in a lot of these countries. And I think the big goal there is for the total pie of commissions on a percentage basis to be lower. So some in the industry think that what has occurred is a big nothing. It's a big nothing burger. It's not going to change the commissions. But the issue there being is that if that is the case, that policymakers might come back, right? It might not be settled. So it will be interesting to kind of see how it plays out. But at the moment, with a market that is slowing because affordability is such a drag on demand, sellers have a bit less leverage than they would have 2 years ago to use this as a moment to get out of paying for the buyer's agents. I think if this ruling had occurred 2 years ago, the timeline of how it played out might have been different, given how leverage buyers had at that time.
Well, you say, the policymakers think that the overpriced commission skill, but I would remind them that NAR is probably one of the biggest lobbyists in the country. And they've been lobbying for the housing market, and their 1.5 million licensees that pay them a membership check every year, for them to lobby. So, it's kind of interesting how the tides are kind of turning. But they certainly want to blame somebody. I know a lot of people want to think it's the real estate agent's fault that home prices are where they are right now. I mean, I think that there's a whole collective reason of why, but I do think that there are agents out there that have, without having a proper experience, that probably didn't help it when they were encouraging their buyers to buy a house, a 30-year investment without a home inspection. And now I think a huge amount of those buyers are kind of,
Well, let's just call it what it is that affordability has gotten so deteriorated, right? Between the prices overheating, the rates shock, and then income's not keeping up, that affordability is just maxed, right? And so there's a huge amount of pressure on politicians to act, and there's not a lot they can do, really. They can act like they're going to do a lot, but what they will do a lot of is scapegoating, right? And they're going to scapegoat everyone across the industry, of course. But I think two of the big events that have kind of helped to lead us here, in my view, the first one is that we had during the housing bust from 15 years ago, we really had an overcorrection in the market where things went too far down and we busted too deep. And we completely changed all of the mortgage standards in the middle of a crash, right? And that just sunk us even deeper. And at that point, what occurred is that single family home building just had a complete blowout, right? And a huge number of the small builders across the country just gone, right? The supply chain's devastated because you can't have 5, 6, 7 years down at that level and keep your supply chain intact. And so the recovery for single family home building just wasn't where it should have been. And we didn't build enough single family homes during that period. So that's the first part. And then the second part is that during the pandemic economics overheated demand, and supply is not elastic like demand. So supply can't catch up, and you overheat the elastic part, which is this demand, it just soars. And then prices just swing up so fast that affordability gets to where we are today. So I think those are two big things, and housing moves real slow and it takes a long time for things to work out. And that's where we are right now, is we're in the process of things, healing. Really unhealthy market. It needs to have some healing. And in the meantime, until things are healed, we're just in a very constrained housing market.
Final question for you, Lance. How do you advise our first time buyers right now? If you were, talking to your kid, your best friend, what would you tell them if they're in the housing market right now wanting to buy a house? Would you tell them to find a house and buy it right now, or would you tell them to hang on and wait and see what happens in the next 5 to 6 months?
I think the big thing that I would tell them is to kind of understand what is their horizon. Like, what are they on a really long horizon? Because if you're somebody who's planning to buy something, and this is really a case where I live in the Midwest, where people buy and they hold for a really long time, 10, 15, 20 years, maybe they hold forever. And so with that type of horizon in a market like this, you as a buyer in some parts of the country are starting to get more leverage, and you've been getting more leverage for 2 years to some degree, and it kind of varies across the country, but you're getting more leverage. And so if you have a really long horizon and you're starting to get more leverage, if you get in a situation where, don't rush, because you do have the leverage, you have the time now. Whereas buying in 2021, you didn't have time, right? You had to act quickly if you were going to buy. But in this market, you have time. And so if you have a long horizon and you have some leverage, if you find the exact thing that you want in the school district that you want, and it's at a reasonable price and you can afford it, and you feel like you're in a good place for income, and you kind of go in knowing that, hey, maybe, prices could fall a bit more, but this is something I want. And over time, it'll smooth out and be fine. I think that person, you kind of maybe, if they're going to do it, they're going to do it, right? Now, if you're somebody on a shorter time horizon, and you're buying in a market that really got overheated for prices, and there are zip codes in the country where prices went up 80%, 100%. And if you're on a short horizon and you're in those places where prices really ripped a lot, it's probably a lot more caution, right? And so I never wanted to tell people that, go buy or sell. I don't want to push people too hard, but I think assess your horizon and know that there's a possibility that, prices could come down some. Um, and, there's also a situation where, a possibility where we could go sideways for prices in some of these markets. And so I think it's a really big just assessment of where you are as a buyer and a seller, is the advice that I would give.
Yeah, I think that's good advice. I'd do the same thing. I mean, if you're going to stay at a place a couple years, and problem with a lot of our younger generation, they've never lived at a place for very long, except home with their parents in a lot of cases. They've moved around in college. They've moved around since college, and and they make a decision, and 3 years from now, they realize they want to be somewhere else. So I think you're right. If it's a possibility, you may be there less than 7, 8, 9 years. Probably best to hold on to Lance.
And so for that person, I would add a little bit more advice, which is if you're somebody who's going to buy something and only be there 2, 3, 4 years, if you do have a situation like you're one of these people in Austin that bought in 2022 at the top, well, not only have prices come down, but then if you go to sell 3, 4 years, you have all the transaction cost, right? Paying for your agent, paying for their agent, and you're probably going to have to still pay for their agent because you might still be in a down market. And that can kind of really compound that cost of getting out of that. And so I think those, the shorter the time frame, the more caution, especially in some of these overheated markets.
Great advice, man. Well, thanks so much. We'll be chatting with you again, I'm sure.
Anytime. And if people want to follow my work, they could Google ResiClubAnalytics.com, sign up for my newsletter. I have a free one that goes out several times a week. I also have a paid subscription with more reporting and more data. And then people can also find me on Twitter @NewsLambert.
We'll post all those links below.
Awesome. Thank you for having me.
Talk to you soon. Thank you for making it to the end of the show. If you haven't already subscribed to Sachs Realty's YouTube channel, please take a moment and do so now. Hit that alert bell. You'll know every time we upload content just like this. And if you like the show, you can let Lance and I know that you did by smashing that thumbs up. By doing this, it will actually help the algorithms push this video out to more people so that we can build an amazing online audience together. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.